You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie.
I'm Miro.
And today is Thursday, February 5th, 2026. We are looking at Linde, ticker LIN, the industrial gas giant that usually defines the word boring, but this quarter felt a little sharp-elbowed, didn't it? And just a quick reminder before we dive in, these are just our personal opinions, not financial advice, so please do your own homework.
Yeah, sharp is one way to put it. Confused might be another. If you just looked at the morning bell, you'd think it was a party. The stock popped to 472 at the open and then spent the rest of the day bleeding out. Closed down 2.5% at 460.
That's a classic fade, the pop and drop.
Right. And I think the market realized pretty quickly that the headline numbers were masking some structural cracks. Top line was fine. Revenue came in at $8.76 billion, up about 1.7% from last quarter. Adjusted EPS hit $4.20 a share, which is basically flat against Q3's $4.21. So stability on the surface. Right,
stability. But then you turn the page and see the reported EPS dropped to $3.26. That's a massive gap, almost $1 difference per share.
Exactly. And that gap has a name, a $229 million pre-tax charge, primarily for severance.
Okay, hold on. Linde is usually the steady Eddie. If they're booking a $250 million charge to fire people, that doesn't scream steady growth to me. That sounds like hunkering down.
It's defensive. Look, they're calling it a cost reduction program to, quote, fix stranded costs in slow regions, which is corporate speak for Europe is stagnant and we don't think it's coming back anytime soon. And honestly, looking at the guidance, they're basically assuming 0% base volume growth for 2026. Zero.
Wow. So they're growing profits strictly through pricing and cost cutting.
Pretty much, which brings us to the weird paradox of this report. On one hand, they're slashing headcount. On the other hand, the project backlog hit a record $10 billion, up from their usual $7 to $8 billion range. So they're firing people in the old economy businesses while booking massive future projects in the new stuff.
It's like they're trying to swap out the engine while the plane is still in the air. And speaking of the new stuff, I have to ask about the rocket fuel. I saw a headline that they have $500 million booked for space launch propellants. Since when is Linde a space stock?
Since about 3 years ago, apparently. Yeah, Sanjeev, the CEO, actually called it a secular growth opportunity. It's sexy, right? Selling propulsion gases to launch providers. It sounds great on the call, but let's be real. That's future money. The today money is still welding gases and manufacturing. And that part of the business is grinding gears. That $229 million charge is the reality check. The space backlog is the dream.
I love that. The reality is the charge. The backlog is the dream. It feels like investors are struggling to figure out which one matters more right now.
Well, judging by the chart today, they decided reality matters more, especially with the CFO saying heroes aren't made in the first quarter. That's a very polite way of telling Wall Street to lower its expectations.
It's definitely cautious. Guarded, I think was the word they used. All right, let's peel this back a bit. I want to understand where this money is actually going if it's not going into volumes. So let's poke a hole in the shiny armor. People buy Linde as the ultimate inflation hedge, right? You raise costs, they raise prices, the margin stays protected. It's supposed to be physics. Mm-hmm. But this quarter, the adjusted operating margin actually slipped.
Yeah, down 20 bips from Q3. 29.5%. And look, in normal world math, 20 bips is nothing. It's a rounding error. But for Linde, it's like seeing a crack in a dam. This is the company that grinds out margin expansion in its sleep. So when I saw that dip, I immediately went to the appendix to see who messed up.
And who's the culprit?
It's the phantom segment they call other. Usually this bucket, which includes corporate costs, some hydrogen stuff, and helium wholesale, throws off about $40 million in profit. This quarter, $6 million.
6 million? That's a rounding error on 8 billion in sales. What happened?
Helium pricing collapsed. We're seeing, quote, high single-digit negative pricing there. Plus, some insurance recoveries from last year didn't repeat. It highlights a vulnerability we forget about. Linde isn't just about simple air gases like oxygen and nitrogen. They're exposed to commodities like helium where they don't have that absolute pricing god mode they have elsewhere.
Right. It's a reminder that even monopolies have leaky roofs. But okay, surely investors are looking past the helium pricing because of that massive backlog we mentioned. I mean, $10 billion in secured projects. That's the record high. Doesn't that basically guarantee the next 3 years of growth?
Guarantee is a dangerous word. Here's the thing about a $10 billion backlog. It's heavy. You have to carry it before you can cash it. Look at the cash flow statement. CapEx this quarter was nearly $1.5 billion. That's up significantly. They're pouring concrete and steel into the ground now for TSMC in Arizona, for clean energy projects, but the cash register doesn't ring until the valve opens.
So it's a cash drag.
Exactly. Return on capital actually dropped slightly because the asset base is swelling faster than the profits. And Sanjeev Lamba said something interesting on the call, which honestly sounded almost zen. He said,
I thought that.
The best backlog is one that shrinks before it grows back up again, which feels like a riddle.
It does, doesn't it? The best backlog shrinks. But he's right. A growing backlog just means you're winning contracts. A shrinking backlog means you're actually turning them on and booking revenue. Right now, the backlog is swollen. They need to start burning it down to justify this stock price. Basically, the factory's being built, the machines are ordered, but until smoke comes out of the chimney, it's just a very expensive construction site.
Well, and it's a construction site in a neighborhood that's sort of burning down. I'm mixing metaphors horribly here, but they're guiding for 0% base volume growth in 2026. Zero. That implies that all those traditional steel mills and chemical plants are just comatose.
They're retrenching. Lamba was surprisingly blunt about this. He basically said the economy is schizophrenic. On one side, you have this exuberant AI investment, which explains why the engineering segment sales surged 18% this quarter. Everyone's rushing to build complex plants. But on the other side, manufacturing, metals, real economy stuff. It's dead flat. So you end up with this bizarre dynamic where they're selling advanced electronic gases for 2-nanometer chips in Arizona while laying off staff in traditional European industrial centers because no one is making steel.
It's the K-shaped recovery playing out inside a single company's income statement.
Precisely.
And that restructuring charge, that $200 million hit we talked about, that's them betting that the bottom leg of the K isn't snapping back anytime soon. They're not waiting for a cyclical rebound. They're cutting the fat now.
Which brings us to the awkward question. If the old world is shrinking and the new world is expensive to build, where does that leave the stock for the next 6 months? Honestly, it leaves it in limbo. They guided for 6 to 9% earnings growth next year. In this market, for a company this size, that's adequate. But it's definitely not the super intelligence rocket ship people want it to be.
Adequate is generous. They called it prudent. Remember, with that assumption of 0% volume growth, they are basically engineering that EPS number. It's not coming from selling more gas. It's coming from raising prices and buying back their own stock.
Right. The buybacks were huge this quarter. $1.4 billion?
Yeah, the CFO saw the stock dip and essentially said, "We'll take that, thank you." That sets a floor under the price, sure, but it changes the narrative. You're not buying Linde right now for growth. You're buying it because you're scared the rest of the manufacturing economy is going to fall off a cliff, and you think this is the safest bunker to hide in.
That's a stark picture, Miro. So it's less about winning the race and more about just surviving the manufacturing recession with your margins intact?
Precisely. They are fortifying the castle.
So, final thought before we wrap up. What is the one thing, just one, that you're watching like a hawk for Q1?
I'm watching that backlog number. Sanju said he wants it to shrink. If we come back in 3 months and the backlog has grown again to 10.2 or 10.5 billion without revenue picking up, then we have a problem. That means the future keeps getting pushed further out to the right.
So we actually want the backlog to get smaller. Finance is weird.
It is. I want to see them stop building and start billing.
Stop building and start billing. I like that. I might put that on a t-shirt. Well, on that wonderfully pragmatic note, I think we squeezed all the gas out of this tank.
Please, no more puns. I'm at my limit.
And on that note, that's a wrap for this quarter. Before we sign off completely, I want to take a quick moment to pull back the curtain. Earnings Unscripted is an experiment by a small team of enthusiastic people exploring the frontier of AI, specifically how it can be used to actually enrich us. To be transparent, this episode was created by a team of AI agents working together, from the research analyst parsing the data and the scriptwriter structuring our dialogue, to us as hosts and even a fact-checking QA specialist. The goal is to combine speed with depth, delivering high-quality, up-to-date information in a way that would hardly be possible otherwise. Since this is an experiment, we'd really love your feedback. Did we miss the mark? Did you learn something? Reach out to us at earningsunscripted@datamadness.ca or follow us on X. Thanks for being part of this with us.
See you after the next call.